Your next reading is derivatives, pricing and valuation. End of chapter questions. Question number 1. For a risk-averse investor, the price of a risky asset, assuming no additional cost and benefits of holding that asset, is unrelated to risk-free rate, directly related to the level of risk, or inversely related to its level of risk. First of all, an asset's current price is determined by discounting its expected future price by the risk-free rate plus the risk premium, denoted as lambda, raised to the time t, the periods of discounting. So as you can see, for a risk-averse investor, the price of a risky asset, assuming no additional cost and benefits of holding the asset, is inversely related to the level of risk. If the risk goes up, the denominator becomes larger, hence the price of the risky asset will fall. So they are inversely related to the level of risk. The price of the risky asset is inversely related to its level of risk. So which means not directly or not unrelated. They are related but inversely related. So that makes C to be the correct option. Next, an arbitrage opportunity is least likely to be exploited when one position is illiquid. Well, that's a correct option, because if the position is illiquid, it will be nearly impossible or difficult to realize gains by disposing of this illiquid position. So this is the situation where the opportunity, the arbitrage opportunity, is least likely to be exploited. So when the price differential between the asset is large, you can make gains on arbitrage opportunity. The investor can execute a transaction in large volumes, hence B and C are possible. But when one of the position is illiquid, in that case it is least likely to generate arbitrage profit. Okay, next. An arbitrager will most likely execute a trade when the transaction costs are low. Correct. So if there is an arbitrage opportunity and the price differential is small, let's say in one market the asset sells for $50, in other market the similar asset sells for 50.75, for example. So this small $0.75 gain is only worth exploiting when the transaction cost is less than 0.75. So when the transaction costs are low, arbitrager will most likely execute a trade. When cost of short selling are high, higher cost will take away the profits. Prices are consistent with the law of one price. So when the prices are the same, there is no arbitrage opportunity. If the law of one price holds, then there is no arbitrage opportunity. So that makes A to be the correct option. An arbitrage transaction generates a net inflow of the funds throughout the holding period, at the end, or at the start. First of all, what is arbitrage? Arbitrage is simultaneously buying and selling of two identical assets or portfolio in two markets, market 1, market 2, and you can generate the returns by buying in one market and selling it in another. Right? So you will buy from the market where the prices are low and sell it in the market where the prices are high. So this way you can generate a net inflow of funds at the start of the holding period. And to the contrary, if you have two assets or a group of assets, portfolio, and they produce identical results, so you have a long position in one and the short position in the other, that means that at the end of the holding period, the payoffs offset. Right? So basically then there is no money gained or loss at the end of the holding period. So there is no risk. So this is the right option at the start of the holding period. That makes C to be the correct option. Which of the following combinations replicates a long derivative position, a short derivative and a long asset, a long asset and a short risk-free bond, a short derivative and a short risk-free bond? If you have gone through the reading and attended my overview lecture video you would know this. A long asset plus short risk-free asset, that is risk-free bond, gives you a long derivative. So you need to memorize this equation. That would help you do many questions of this type. So that makes B to be the correct option. Next. Most derivatives are priced by assuming that the market offers arbitrage opportunities. Absolutely wrong. Derivatives are priced by assuming that the market is free of arbitrage opportunity. There is no arbitrage opportunity. So A is incorrect. B. Most derivatives are priced by discounting the expected payoff of the derivative at the risk-free rate. That is true. All derivative pricing models discount the expected payoff of the derivative at the risk-free rate. So that makes B to be the correct option. Why not C? Applying a risk premium to the expected payoff of the derivative and its risk. That's we don't do in pricing the derivative, and investors' risk premium is not relevant to pricing a derivative. It's an incorrect option. So B is the right option. Next, the price of a forward contract is the amount paid at initiation, or is the amount paid at expiration, or fluctuates over the term of the contract. First of all, the price of a forward contract, price, not the value. The price of the forward contract is agreed upon at the inception of the contract, and it is fixed. Yes, payment is made at expiration, but the price is fixed at the initiation of the contract. So the amount paid at initiation, not the amount paid at initiation, the amount that will be paid at expiration, and it is fixed, and it doesn't fluctuate over the term of the contract. Value of the forward contract may fluctuate, but not the price, because price under the forward contract is fixed at the very start. So that makes B to be the correct option, because and that fixed amount is paid at expiration. B is the right option. Next, assume an asset pays no dividend or interest, and also assume that the asset does not yield any non-financial benefits or incur any carrying cost. So at initiation, the price of a forward contract on that asset is, as we just discussed in the previous question, the price of the forward contract is fixed at the initiation, whereas the value of the forward contract is 0 at initiation. So what we can say, at initiation, the price of the forward contract on the asset is greater than the value of the contract, because value of the contract is 0, the forward contract price is fixed. So price would be greater than the value of the contract. So that makes C to be the correct option. Next, with respect to a forward contract, as market conditions change, only the price fluctuates. Wrong. The price has already been fixed at the initiation. That's what I've been saying in the last two questions. Only the value fluctuates. Correct. Only the value fluctuates, not both the price and value. That makes a pretty straightforward question. B is the right option. Next, the value of a forward contract at expiration. This is how we calculate the value of the forward contract. It's the difference between the spot price and the forward price. So now let's consider there are two parties. One is the long party, other is the short party. So the long party would profit from paying a forward price that is lower than the spot price. So in that case, spot price has to be higher than the forward price. So the value of a forward contract expiration is positive to the long party. Yes, it's positive. 100 is the spot price, 90 is the forward price. So positive to the long party, the spot price is higher than the forward price. And conversely speaking, if the spot price is 90 and the forward price is 100, in that case, the short party profits from receiving the higher forward price than the spot price. So in this case, we get A to be the correct option. The value of forward contract expiration is positive to the long party and negative to the short party. Right? So that makes A, then you can correlate option B and C accordingly. A is the right option. Next question. At the initiation of a forward contract on an asset that neither receives benefits nor incurs carrying costs during the term of the contract, the forward price is equal to, this is the formula we use for forward price. Forward price is equal to spot price? No. Is it the present value of the spot price? In that case, we would have seen negative T here. No. Then it is the future value of the spot price. And this compounding is being done at the risk-free rate over the life of the contract. So that makes B to be the correct option. Next stock BWQ and ZER are each currently priced at 100. Let us write this down. Are currently priced at $100. Over the next year, stock BWQ is expected to generate significant positive benefits, whereas stock ZER is not expected to generate any benefit at all. So there are no carrying costs associated with holding either stock over the next year. Compared with ZER, the 1 year forward price of BWQ is likely to be lower, same or higher. We know from our reading that the forward price is basically found by compounding the spot price by the risk-free rate for the period and then subtracting any future value of benefit and adding any future value of cost. So basically the benefit is deducted, the cost is added, which means the future value, the forward value of BWQ is going to be lower than ZER. The question says, compared with ZER, the 1 year forward price of BWQ is most likely be lower because the benefits needs to be deducted in order to calculate the forward price. Had there been no benefit or cost, both would have the same forward price. But since BWQ has a benefit, it needs to be deducted, the future value of benefit, so its value will be lower. That makes A to be the correct option. If the net cost of carry of an asset is positive, then the price of the forward contract on that asset is most likely. We know the forward contract value can be calculated using this formula: spot minus any benefit plus any cost times the compounding factor. Now, if the net cost, now then we have to rearrange this formula since it's talking about net cost. So for that, the formula rearranged will be something like this: the spot times 1 plus R times T minus benefit and cost times the compounding factor. Now, if the net cost of carrying an asset is positive, which means this factor is positive, mean benefits less cost, there are more benefits, less cost. So in that case, this factor would be deducted. It's a deduction from this factor, right? Compare this with a net cost of carrying 0. So when you deduct, now we have two situations. When the net cost of carry was 0, in that case, you have, let's say, this 100. But when the net cost is positive, which means this element overall is to be deducted, and let's say that net cost which is positive is 9, for example. So in that case, the forward contract will have a value of 91. So it's just verbosity, he just played with the words. So if the net cost of carrying of an asset is positive, then the price of the forward contract on that asset is most likely lower than if the net cost of carry was 0. So if net cost of carry was 0, the forward contract has 100 value, and if the net cost of carry is 9 in our example, positive, that positive needs to be deducted from 100. So in that case, the forward value would be 91. So the final conclusion is that the price of a forward contract on that asset is more likely to be lower than if the net cost of carrying was 0. In case of 0 is 100, in case of positive cost of carrying 9, then you have 91 as the forward value. So that makes A to be the correct option. Right, next. If the present value of a storage cost exceeds the present value of its convenience yield, then the commodity's forward price is most likely. Here we go. Let us just write this down in a more extended form. Forward price is equal to S0 times 1 plus RT minus benefit times, I'm separating it, every element separated and discounted and compounded separately, 1 plus R raised to the power T plus cost times 1 plus RT. Now let's do it. If the present value of the storage cost exceeds the present value of the convenience, let's say if this is 100, just assume numbers, and let's say if this is 90. If the present value of the storage cost exceeds the present value of its convenience yields, then the commodity's forward price is most likely be higher. There will be a net 10 to be added in the compounded spot. So that makes C to be the correct option, higher than the spot price compounded at the risk-free rate. Without doubt, C. The formula says it so. C is the right option. Next, which of the following factors most likely explain why the spot price of a commodity in short supply can be greater than its forward price? Convenience yield is the benefit of holding the asset and generally exists when the commodity is in short supply. So we have just seen the future value, the forward, is the sum of compounding spot, compounding benefit, and adding the cost. So if there is convenience yield, that means this element would be bigger, thereby this would reduce the forward price and your spot price would be higher. So this is because of convenience yields. It's just the rearrangement of the formula. Next, when interest rates are constant, future prices are most likely less than forward prices, equal to forward prices, or greater than forward prices. Please remember, when interest rates are constant, futures and forwards, they will have equal price. That makes B to be the correct option. In contrast to forward contracts, future contracts trade over the counter. No, future contracts are exchange traded. This is the incorrect option. Future contracts is initiated at 0 value. That is true for forward as well. We are looking for a unique characteristic that is correct for futures contract. Yes, future contracts are marked to market on daily basis. This is true. This is correct statement. Future contracts are marked to market on daily basis, and then the gains and losses are either charged or credited to the account. That makes C to be the correct option. Next, to the holder of a long position, it is more desirable to own a forward contract than a future contract when the interest rates and future prices are. Let us move one by one. Let us first discuss uncorrelated. If the future prices and interest rates are uncorrelated, forward and future prices will be the same. Right? Now, if the future prices are positively correlated with the interest rate, in that case, future contracts are more desirable to holders of long positions than forwards. In that case, future contracts will be more desirable. So in this case, we will prefer future contracts. Now, coming back to the correct option. Now, if the future prices and interest rates are negatively correlated, then we will prefer forwards. Forwards are more desirable to the holders of long positions. So that gives us A as your correct option. Next, the value of a swap typically is non-zero at initiation, is obtained through replication, and does not fluctuate over the life of the contract. Let us discuss. Valuation of swap during its life is what attracts replication, and that's where you make use of arbitrage. So it's basically the replication that gives the swap its value, right? Why not A? Remember, the swap price is typically set such that the swap contract has a value of 0 at initiation, not non-zero. Moreover, the value of a swap contract will fluctuate during the life of the contract as the value of the underlying changes in value. So it doesn't fluctuate, it does. That makes B to be the correct option. The price of swap typically is 0 at initiation. Well, the swap value can be 0 but not the price. This is not correct option. Swap price is determined at initiation by replication. So value can be 0 but not the price. Why not B? The value of the swap fluctuates over life of the contract, not price. Price is essentially fixed. Incorrect. Then the price of the swap typically is obtained through a process of replication. That is correct. That is the correct option. Replication is the key to pricing a swap, and that makes C to be the correct option. Next, the value of a swap is equal to the present value of the net cash flow payments from the swap. So it is determined either by deducting the difference between present value of fixed minus present value of floating, or present value of floating minus present value of fixed, depending upon which side of the contract you are on. So basically the value of the swap is equal to the present value of the net cash flow payments from the swap. And that makes B to be the correct option. Next. If no cash is initially exchanged, a swap is comparable to a series of forward contracts when the swap payments are variable. Incorrect, because for a swap all payments are fixed and equal, not variable. Then the combined value of all contracts, forward contracts, is 0. Now this is true. This is true. Some of the forward contracts have positive values, some will have negative values, but their combined value will be equal to 0. Why not C? C is incorrect because the forward contracts expiring at different times will have different prices, not the same prices. That makes B to be the correct option. Next. For a swap in which a series of fixed payments is exchanged for a series of floating payments, the parties to the transactions designate the value of the underlying at contract initiation. Incorrect, because in swap a series of fixed payments are exchanged for a series of floating payments. So each floating payment reflects the value of underlying at the time of payment, and it is not decided or designated value at the contract initiation. Incorrect. B. The value of the underlying solely on the basis of its market value at the end of the swap. This is incorrect as well, because in swap that involves a series of fixed payments exchanged for a series of floating payment, each floating payment is based on the value of the underlying at the time of each respective payment, not on the market value at the end of the swap. Then it has to be C. The value of underlying sequentially at the time of each payment to determine the floating payment. This is correct. On each payment date, the swap owner receives a payment based upon what? Based upon the value of the underlying at the time of each respective payment. It's a straightforward correct option, C. Next. A European call option and a European put option are written on the same underlying, and both options have the same expiration date and same exercise price, let's say $50. At expiration, it is possible that both options will have negative values. Now that is incorrect, Because if put option has a positive value, then call will have negative. If put is negative, call will be positive. So they cannot be negative and positively simultaneously. Yes, they can be zero at the same point. They can be zero at the same point. In that case, if the exercise price is 50 in case of put and call, the underlying also has a market price of 50. So if the price of the underlying is the same as the exercise price of put and call in both cases, then put and call will be at the money, which means 0-0. Both cases the options are not worth exercising because the underlying has the same price as the strike price of the option, so they will have 0 value, which is the same value. So that makes B to be the correct option. At expiration, a European put option will be valuable if the exercise price is, you have a put option that gives you the right to sell, right? It will be worth exercising if the market price is lower than the strike price, right? So in that case, or conversely speaking, your exercise price has to be greater than the underlying price, or vice versa, as I've just told you. So C is the right option. Let me explain. You hold a put option that gives you the right to sell the asset at 50, and at the expiration date, the market price, the underlying price is 45. So in this case, you will surely exercise the put option. You will exercise the option if the exercise price is greater than the underlying market price. That makes C to be the correct option. Okay, the next question says the value of a European call option at expiration is greater of 0 or the value of the underlying, that's the stock, minus the exercise price. So that clearly matches with the value of the underlying, that is ST, and the exercise price X. So that makes B to be the correct option. It's a pretty straightforward question. Next, for a European call option with the 2 months until expiration, if the spot price, you have the call option, that's right to buy, right? If the spot price is below the exercise price, the call option will most likely have, now since the spot price is let's say $45 and exercise price is let's say $50. So in that case, it doesn't have a positive exercise value. Even it can be exercised only at the expiration, but it doesn't have a positive exercise value. But it does have a positive time value. Why? Because since you hold the call option and there are 2 months till expiry, so instead of just purchasing the share right away, the funds can be invested and can generate a positive NPV for the 2 months. So it has a positive time value. That makes B to be the correct option. When the price of the underlying is below the exercise price, you have a put option that is right to sell at $80, whereas the price is $45. Let's say, just assume numbers. So when the price of the underlying is below the exercise price and you have the right to sell at $80, in that case, we say the option is in the money, you will surely exercise the option in this case. That makes A to be the correct option. If the risk-free rate increases, the value of an in-the-money European put option will most likely, now look at this, when the risk-free interest rate increase, that will lower the present value of any proceeds you will receive on the exercise. Since it is reducing the present value of any proceeds on the exercise date, so this will decrease the value of put option. So that makes A to be the correct option. The value of a European call option is inversely related to exercise price. Yes, if the exercise price is higher, the value of call option will be lower. You know this from your reading overview. It is positively correlated with the time to expiration. More time to expiration, the European call option will have more value. More volatility, more value. But if there is more exercise price, higher exercise price, the value of European call option would be lower. Next, so that makes A to be the correct option. The table below shows 3 European call options on the same underlying. We have 3 options, option 1, 2, 3. One is for 3 months, 6 months, 6 months, and they have these exercise price. First of all, when we compare these two having same exercise price, so when we have to select between 1 and 2, we will surely go for option 2 because it covers a longer period, more time to expiration, means more valuable call option. Then, since option 1 has been rejected, now we have to compare between option 2 and 3. Since they have both same time to expiration, now the point will come which one has the lower exercise price, the right to buy. The lower right to buy is good for me. That makes option 2 to be the correct option, option B. Next, the value of a European put option can either directly or inversely be related to the. Let us discuss options one by one. If the exercise price is higher, that gives you the right to sell at a higher price, in that case the value of the put option would increase, the right to sell at a higher price. So direct proportion always. Volatility of the underlying. If there is more volatility in the underlying, the value of the put option would be higher. So in A and C will always be in direct proportion. But time to expiration. First thing, that when there is more time till expiration, it will increase the value of put option in most of the cases. Okay. So, but if the longer the time to expiration, higher will be the risk-free rate, and this would lower the value of put option. So they can have a direct and indirect relationship at the same time. Time to expiration, B is the right option. Prior to expiration, the lowest value of a European put option is the greater of 0, right? Or the present value, not the exercise price, because we are prior to expiration. We are at the point where that is prior to expiration. So it's going to be the present value of exercise price less the price of the underlying. So that is the right option. Present value of the exercise price minus the value of the underlying P. So prior to expiration, the lowest value of an European put option is the greater of 0 or the present value of exercise price minus the value of underlying. That makes B to be the correct option. Moving on. A European put option on a dividend paying stock is most likely to increase if there is an increase in which of these? Carrying cost, risk-free rate, or dividend payments. If the carrying cost increases, it will reduce the value of put option. So this is incorrect. From your reading, you would know the increase in risk-free rate, it increases the value of call option, but it decreases the value of put option. So this is incorrect as well. But dividend payments, this is interesting. The payments such as dividends, they will reduce the value of the underlying, which at the same time increases the value of European put option. That makes C to be the correct option. Based on put-call parity, a trader who combines a long asset, a long put, and a short call will create a synthetic. Let me show you. Okay, here we go. Now, based on put-call parity, a trader who combines a long asset, a long put, and a short call, basically he will create a synthetic long bond, A. So, which of the following transactions is equivalent to a synthetic long call? Here we go. You would know from your readings overview. It's long asset, long put, and short bond. This will give you synthetic call. That makes B to be the correct option. Which of the following is least likely to be required by binomial option pricing model. Spot price, yes, we need that. Two possible prices, one period later, correct. Actual probabilities of the up and down moves, no. We don't need actual probabilities. Rather, we are looking for only risk-neutral probabilities, we call the pseudo probabilities. That makes C to be the correct option. Next. To determine the price of an option today, the binomial model requires selling one put and buying one offsetting call. Not buying or selling. In fact, pricing an option under binomial model only relies on the fact that the perfectly hedged investment earns the risk-free rate. So that makes C to be the correct option. Assume a call option strike price is initially equal to the price of its underlying stock. Let's say the strike price is 80 and the price of the underlying is also 80. Based on the binomial model, if the volatility of the underlying decreases, the lower of the two potential payoffs. We know when the volatility of the underlying decreases, the value of the option also decreases, meaning that the upper payoff value of the hedge portfolio, this part, it will decrease, right? But the lower, this one, it would still remain 0. So the lower of the two potential payoff values, the hedge portfolio, remains the same, 0. That makes B to be the correct option. Based on the binomial model, an increase in the actual probability of an upward move in the underlying will result in the option. We have just agreed a little while ago, we do not use actual probabilities in the binomial model. Thus, any change in the actual probability will basically have no impact upon the pricing of the options, or in fact the valuing of the option. So that makes B to be the correct option. If a call option is priced higher than the binomial model predicts, call option is priced at 80, whereas the binomial model predicts it to be 78. What an investor will do? The investor will simply sell a call. He will sell a call at a higher price because the option price is higher than the binomial model prediction. So the trader will engage in an arbitrage contract by selling a call at 80. He will buy the stock or the underlying, and for necessary funding he will borrow at the risk-free rate. So this will earn a return in excess of the risk-free rate. So that makes C to be the correct option. Borrowing at risk-free rate, selling a call, and buying the underlying. C is the right option. An at-the-money American call option on a stock that pays no dividends has 3 months remaining until expiration. The market value of the option will most likely be well before the expiry. Usually American call options have a value in the market that is greater than its exercise value. So it's a pretty straightforward question. C is the right option. At expiration, American call options are worth less than European call option, more than European call option, or the same as European call option. Remember, at expiration, both American and European call options are effectively the same. Both are valued at greater of 0 and the exercise price. That makes B to be the correct option. Which of the following circumstances will most likely affect the value of an American call option relative to European call option? Well, dividends are declared. When a dividend is declared, an American call option will have a higher value than a European call option. Why? Because after the dividend, an American call option holder can simply exercise it early to capture the value of the dividend, but no such possibility in European call option, because European call option can only be exercised at expiration date. Whereas expiration date occurs, they affect both American and European option in the same way. Risk-free rate changes affects them in the same way. This is what differs between these two. A is the correct option. Combining a protective put with a forward contract. Now this is your put called forward parity. Okay, now this is your protective put and a forward contract. It generates an equivalent outcome at expiration to those of a fiduciary call. If you have done your reading overview, you would know that this aspect represents the fiduciary call. That makes A to be the correct option. Holding an asset and buying a put option on that asset is equivalent to, well, if you hold the asset, long on the asset, and you also buy a put option, this is equivalent to fiduciary call. From your overview, it's all from there. If you have got good understanding from the overview, it's a pretty straightforward question.